All right, what's good, everyone? This is Dr. Nee. We are here for another tip with Eric McGlothen, CPA. Basically, the man to be in Atlanta with your taxes. He works with real estate professionals, he works with doctors, he works with a whole host of different businesses, and he's helping us try to retain more of our tax burden or decrease our tax burden as we start to go into side hustles, go into locum tenens, and so forth. So, Eric, what's up? Welcome to Docs Outside the Box.
What's up, Dr. Darko? Good to see you again.
So listen, let's jump into another tip. This one is for the employed doctor, right? This is the doctor who works at a hospital. This is a doctor who may work for a private practice firm, doesn't own the private practice, but either way is getting what we call W-2, is listed as a W-2 and gets a salary and pays their taxes. What kind of things can they do to decrease their tax burden? What kind of options do they have?
All right, so first of all, let me say that W-2 income is the hardest income to plan for. So that is why typically as a CPA, I'm always advising my clients if you can get into locums tenens work, if you can get 1099 income, any other income besides W-2, that is what we want to go for. But let's just say that's not your situation. You're W-2, you're happy with W-2, that's where you're living. So then if that's the case, the first thing I say is let's go after the low-hanging fruit. Let's go after, are you maximizing the money going into your retirement account? That's easy, low hanging fruit that if you put in pre tax, because now we have options, you can do after tax or pre tax. You want an immediate tax savings, you want pre tax contributions, meaning income that's not going to be taxed, which reduces your taxable income, which reduces the amount of tax you pay on your annual return. Maximize the money you put into your retirement account. Secondly, what I would say is maximize the money you put into your health savings account, because that too is pre-tax money and reduces your taxable income and also makes money available for when you have those medical situations that you need to pull that money from. So that's two. The third is charitable contributions. So
Mm,
obviously,
okay.
you can give money to church or to a not-for-profit of your choice, causes you're excited about, colleges and universities that you want to donate to, and so forth, right? But let's also say that you say, look, I made a lot of money this year. I don't even know all the charities and stuff I want to donate to, but I need this write-off. So what can I do? One option is what they call a donor advised fund. Donor advised fund. This is
DAFs. Yeah,
almost like
we've heard about that.
almost like your mini private foundation. It allows you to sock some money away, get an immediate charitable contribution deduction in the year that you make that contribution, but those funds do not have to be distributed to any not-for-profit in that same year. You can distribute it over multiple years. So that is one that I would definitely advise to do. If you're not a big giver or you don't have a lot of causes you know about yet, but you need that write-off, donor advised fund is where you want to be.
Real quick, before you go into the next situation, the donor advised fund, who do you talk to about that? Are you talking to your financial advisor about that, or is that something that folks are talking to you about? Who do they go? Who do you
You
point them in for that?
you could start with your financial advisor if you have one. If you don't have one, then we need to dialogue, because not only do we need to talk about that, but we also need to talk about getting your financial advisor. Every doctor out there
I get what you're
should have a
saying.
financial
I get
advisor.
what you're saying.
Okay, so yeah, there you go.
Financial advisors are like, man, why are you telling on us, man?
Look, I'm just trying to help you.
Uh-huh.
But yeah, but so that's where you want to start at. So they can definitely help you set those up, and administer them for you. So DFAs. The other one that I would recommend along the charitable contribution line, much more riskier. So again, we were going to put the disclaimer out there. This is only for entertainment and information purposes only. You need to consult with your tax professional and your legal advisor regarding this. But conservation easements,
Okay, what is
without
that? I've
getting
never heard of that
so
before.
without getting into all the guts of it, here's the long and the short of it is. And basically, the Internal Revenue Service allows a tax deduction that is multiples of what is contributed on the return, but based on a couple of things. So here's how it basically works, the long and the short. Is if you have a piece of land, right? Set aside a piece of land, you buy it for $100,000, right? That piece of land now gets set aside for conservation purposes. So you can't build on it. Can't build a house, can't build a golf course, can't build a building. Nothing happens on that land. It has no activity. But if you set it aside for conservation easement purposes, right, then what happens is the IRS allows a deduction that is based upon the best and highest use of that land. So let's just say, for example, that $100,000 piece of land, if you put a house on it, maybe it's worth 400,000, right? So the IRS will allow you a charitable write-off of $400,000 in that year.
So wait, this land you're purchasing for conservation, but then you can build your own house on it?
You cannot. So remember what I said. You can't do anything with that land. So this is the downside.
Okay.
It's a hit it. I'm not gonna say it like that. Well, I would say it's a hit it and quit it kind of thing. It's one time. So
I love it, Eric. You could do that. You can talk about this. Come on, bring it. This is the thing we understand. Talk to us like we're fourth graders. Come on.
Right. So it's a piece of land that you can't do anything with. You bought it, and that's it. You're not going to build a house. You're not going to be able to build a commercial building. You're not going to be able to develop it at all, ever, never, ever.
Okay.
But for that, the IRS allows you to get a write-off because you bought this land and because you're not going to do anything with it. It's set aside for conservation purposes. You get to write it off on the return under charitable contributions at its best and highest use value, which is figured out by an appraisal. And from my understanding, again, there's attorneys and stuff that involved with this. I don't do it myself. I work with companies and individuals that do this. But the understanding is with what's happening when the IRS is scrutinizing this, which remember I said this is risky. So you can't be a risk averse person and do conservation easements. You gotta be like, I'm good with it. Just show me what I need to do to minimize my risk.
Right.
But if you do it and if you take advantage of it, right, you can get this big write-off.
Okay. All right. That makes sense. So real quick, let's wrap around, right, with being an employed doctor only or an employed professional only. Those are the tips that you can use. But real quick, just so we understand, when you get a 401k, what does it do to your taxes? And I think that's the key that people don't understand. Yes, people tell me put into a tax advantage account, but I want to know what it does to my taxes. What does that do to your taxes? 401k, what does that do to your taxes? Putting money in your IRA, what does that do to your taxes? And then HSA. Talk to us real quick about that.
Okay, so 401k, right? Let's just use round numbers, $100,000, okay, that you make a year, right? Mm-hmm. If you put in $20,000 into the 401k pre-tax, which means before tax, that reduces that $100,000 that's taxable now down to $80,000 that's taxable.
Now we get
return. It pulls money off the table. Let's just use that word. We're pulling money off the table for tax purposes. So the HSA and the IRA does the same thing. You're pulling money off the table for tax purposes. With the 401k, it's done typically pre-tax out of your paycheck. With an IRA, right, you're taking money typically after you've already gotten paid, taking money out of your bank account and putting it into an IRA. Still, as long as you fall within the income limits, right, you can actually take that as a deduction on your return. And same for the HSA. Now, HSA is pre-tax. So it comes from through your job, through your employer. They'll take that money, put it into the HSA, and it reduces your taxable income.
Okay, now we get it. That makes sense. So if you make $100,000, this is a way to make sure, this is a legal way to make sure that the IRS can only tax you on possibly $80,000 or $75,000, depending on how much commensurate you put into those different accounts. That's what those accounts do.
Yes, and what the limits are on how much you put into the 401k. The other thing I will say is make sure, because now we have Roth 401ks, we have Roth IRAs, and Roth products are after tax. So there's not a tax advantage immediately. The tax advantage on Roth products is the money that I put in and the growth of it, I can get out later tax-free.
Gotcha.
So it's not an immediate benefit now, it's a benefit in the future.
And that's why people need to come and talk to folks like you, because we're not getting that type of information from your run-of-the-mill, TurboTax or H&R Block. No shade on them, but this is higher level type of discussions, guys. So remember, though, this is for entertainment purposes, people. Please get in touch and confer with your tax professional before moving forward with any and anything that you hear on this show. Eric, thanks again for this tip. Listen, how can folks get in touch with you if they want to further this conversation?
You want to further the conversation, go to my website, ericmcglothenllc.com. You can make an appointment that way, find out more information about me, or call my office at 404-946-1855. You can make an appointment so we can talk. Love to help.
Thanks.